So today's video is going to solve a very, very common problem. And that problem is, as a UK investor, for example, how do I easily invest in overseas firms? Okay, there's a problem with buying overseas shares. They're in the wrong currency. They're going to pay dividends in the wrong currency. Maybe you need an account with an overseas broker. Maybe you need an overseas bank account. So is there a way that companies can get you to buy their shares without you having to go through the hassle of trying to work out how to buy an overseas share? And the answer is yes. It's called a depository receipt, and that's what we're going to look at in today's video. This one will be nice and short, a beginner's guide to what depository receipts are and how they help you as an investor and of course the companies that issue them and want to get hold of your cash. Okay, so let's go back to the late 1920s. All right, I think my shirt probably takes you there if nothing else, and take a look at a problem, a real life problem. There's the UK. All right, people who've seen my videos before know my graphics are pretty advanced. So there's the UK, and we'll put Selfridges, the big department store, about there. All right, now imagine you're Selfridges. You're a big department store and you want to attract money from the biggest capital market in the world, contributing today around 20 to 25%, depending on how you measure it, of global GDP, America. Right, you want to tap the American market. So put America over here. All right, that's Mexico, roughly speaking. All right, so there's America, and you want to tap the American market. What are you going to do? All right, so you've got investors over here who might be interested in investing in Selfridges. Now, they've probably heard of Selfridges. All right, lots of American tourists gone over, spent money, gone back and said, oh, Selfridges. You know, so they've probably heard of it, which is the first problem in America, by the way. Not all UK brands have been heard of in America, but Selfridges, people probably know about. But what are you going to sell them? All right, because what are you going to do? Just say, well, that's all right. You can buy for cash Selfridges shares, like anybody else in the UK. Well, that's not going to interest an American investor. I mean, they might like the idea that they could buy into a big British brand like Selfridges, diversify their otherwise American portfolio, but they're buying something in sterling, so that's going to pay dividends in sterling when all their other investments are in dollars, presumably. And how are they going to do it? I mean, do they need to have a UK broking account open? And does that mean they have to have like a UK bank account for the sterling? Okay, so it's all a bit of a mess, frankly. And what are the tax implications for an American investor buying UK shares? And then what if they want to sell them to another American investor? Are they going to sell these sterling denominated shares in the US market? How's that going to work? So for all those reasons, the US investor might be going, well, thanks, but no thanks, actually. Too much hassle. So you need a solution, all right? And depository receipts are the solution. So here we go. Back to the opening scenario. We've still got American investors interested in owning shares in a UK company called Selfridges. Okay, and all we're going to do is this. We're going to stick a depository bank in the middle. Now, that might be JP Morgan, for argument's sake, an investment bank. There are quite a few depository banks around. That's one of them. Okay, and in this example, that works quite nicely because it was JP Morgan. All right, and what they're going to do is this. Basically, they will buy shares in Selfridges. What they'll do is hold them as a kind of custodian or depository and issue a piece of paper that represents them but isn't them to US investors, and that's called a depository receipt. Not surprisingly, an American depository receipt, or ADR. So here's how it works. The US bank then issues what we'll call ADRs, American depository receipts, and of course the US investor can pay for those in their currency, dollars. All right, now the beauty of depository receipts is a little trick here. So the shareholder for Selfridges is JP Morgan, not the US investor. The US investor's got these depository receipts, and here's the great thing about depository receipts. Number one, they're in dollars. So that means the American investor can trade them on in dollars, and that sounds a bit more interesting than sterling. All right, maybe you don't need to have an overseas account, an overseas bank account in order to get hold of these things, okay? You'll get similar shareholder rights owning a depository receipt as you would have owning underlying shares. The one that can vary a bit is voting rights, by the way. Just watch out for that one. Depends on the depository receipt program as to whether you get full voting rights like a UK shareholder or not. Just leave that one floating for a moment. But nonetheless, you have an investment that can be easily bought, easily traded, will pay dividends in the right currency, because the dividends will go from Selfridges into JP Morgan, switched at spot rate, and on in dollars. Lovely. All right, so there you have it, American depository receipts. And since the origin of the depository receipt designed for American investors, things have moved on a bit, okay? Because you might have come across, or you might soon come across, something called the GDR, the Global Depository Receipt. Now, these tend to be listed in places like London, and they enable UK investors to do the same thing. So you'll have a bank that buys up shares in a range of currencies in different countries, okay, and switches, if you like, or holds those shares and then switches them into depository receipts by creating these depository receipts, and they are then listed in London, all right? And those tend to be called global depository receipts, all right? And the underlying company might be trying to raise capital in two markets at once, London and somewhere else, okay? So the beauty of depository receipts is they're not just designed for the American market anymore. I think the earliest ones were, okay? They can be designed for the London or European markets, and they just get a slightly different name usually, global depository receipts. And they enable companies to raise money in local markets, and they also allow investors in those markets to get easy access to companies on similar terms as the ones listed in their local market, okay? So, as a UK investor, buying a GDR gives you similar exposure to an overseas company as buying a UK share would for a UK firm, all right? And just worth mentioning that one of the latest sort of trends, countries where, for example, it's traditionally been difficult for non-institutional or non-local investors to get access, I'm thinking of emerging markets here, depository receipts are quite useful because, you know, if a local government imposes rules saying, well, only certain types of investor are allowed to buy shares and hold them at all in our local market, we impose constraints, okay, then depository receipts can be quite a neat way around that, because maybe an international bank qualifies in the local market, but Tim Bennett doesn't, too small, all right? So the bank can buy up the local shares that I can't, and then create separate, keyword there, separate depository receipts on the back of those shares that Tim Bennett can trade somewhere else like London. So depository receipts can open up not only the problem, if you like, or solve the problem of, you know, having investments in the wrong currency, my first example, but they can also solve the problem of, you know, maybe in some markets, even if I was prepared to buy the shares themselves, I couldn't. So a depository receipt program can solve that problem by giving an investor a piece of paper that's like a share, but isn't the actual shares, okay? And one of the most recent innovations is something called an Indian depository receipt, okay? And that has enabled Indian investors, so it's the other way around, to buy shares in international companies. Okay, there's kind of poacher turned gamekeeper, if ever you heard of it. All right, you know, the Indian market is becoming more and more important. So an Indian depository receipt allows an Indian investor who's otherwise restricted in terms of the amount of overseas shares they can buy. Okay, Indian depository receipts enable them to buy a large quantity of shares if they want to in overseas companies trying to list in India. So you can see lots of uses for these things called depository receipts, and they go by various different names. American depository receipts were the first, and there are lots of those around. Global depository receipts you'll find listed in London quite often, and then you've got the idea of international depository receipts, and even then Indian depository receipts reflecting individual emerging market countries trying to attract companies to list in their local market. Okay. Well, one final point. Are all ADRs, for example, created equal? The answer is no. Just be a little bit careful here. And this is true of most depository receipt programs. There are different levels. Okay, at the bottom level, you've got the sort of unregulated, over-the-counter market in sometimes not very liquid depository receipts. Okay, that's where a company's gone into the local market and trying to do a sort of quick and dirty, make our depository receipts available to local investors job. Okay, those can be a little bit liquid, a little bit difficult to get hold of, not for everyone. Okay, but what's called a level 3 program, I won't go through all the nitty-gritty here, the regulations, but a level 3 program in the US means effectively the depository receipt has the same safety mechanisms behind it as a normal American stock listed in New York. All right, so before you pile in and ask for depository receipts, your broker, or maybe you're thinking you've been offered depository receipts, wondering whether to buy them, all right, do just make sure, it should be the case, that what you're being offered is a sort of fully listed liquid depository receipt, because otherwise, if you pile in to something which is over the counter and lightly regulated, as with any other type of security, you may find them a little bit difficult to shift later on. Right, a final little section for the eagle-eyed amongst you who will have spotted a couple of things. One, I've changed my shirt, and secondly, ADRs are not perfect. Okay, so if you understood what I said back there, here are 3 risks to watch out for with ADRs. Okay, number 1, foreign exchange risk. Some of you will have spotted that dividends come in from the depository bank and are switched at the spot rate into your local currency. That means you are still exposed on the income side to foreign exchange risk. Okay, ADRs don't take that away completely. There's number 1. Number 2, ADRs are not always created exactly the same as shares. It is possible for a bank to buy up, let's say, 10 shares in a UK company and create 1 ADR. There's a ratio there. Okay, it could be 1 for 1, it could be 10 for 1, it could be 5 for 1. Well, why the difference? Okay, well, in the UK, we like to trade lots of small things. Okay, those people who remember Bullseye, remember Jim Bowen at the end saying, let's see what you've won, and fanning out loads of notes. Okay, he never gave away £200 as 450s, if you know what I'm saying. It was always 20 tenors. Why? Because it looks like more money. It's 200 quid. The Americans don't need to fall for that kind of trick. They like to trade a small number of large things. So don't be surprised if you see 10 shares in the UK being taken and made into 1 ADR. Okay, and that, if you're not used to trading large denomination securities, can be a reason not to buy depository receipts, particularly if you're buying them on an overseas exchange. Okay, and thirdly, liquidity. I said that global depository receipts, for example, can be used to open up an emerging market where there isn't good liquidity in the underlying shares. In other words, you can't buy them easily. Okay, now, if you have the underlying shares not very liquid and the depository receipt that's created is very liquid because it's listed somewhere where there is much better liquidity, you can get a difference between the value of the depository receipt at the spot rate and the value of the underlying shares at the spot rate and the depository receipt that's based on them. Okay. Now, for anyone who doesn't get those last 2 or 3 points, not a big problem, but those are 1 or 2 quirks to watch out for. And my very last point, which doesn't require a change of shirt, is this. I'm not saying in this video you shouldn't buy overseas shares in the currency in which they're listed. I'm just saying that an alternative is a depository receipt which takes away 1 or 2 of the downsides of doing exactly that.